Welcome back to the Finance Corner. Today's video is going to be the next video in our series of flipping money with options. And the whole point of the series is using options contracts to make income and generate income and do that on a regular basis. But we are only going to be selling contracts. We're not going to be buying them. So I made a new play based on one of our last Coles play that we did. We're going to go into it and explain the thought process and all that good stuff. And yeah, we're gonna get right into it. There's a lot of crazy things happening in the market. Probably briefly discuss that a little bit too. But yeah, today I'm actually on a cruise to the Bahamas. No, we're going to Barbados. Yeah, the Caribbean, Barbados, and it's pretty fun. My first time on a cruise. Pretty overwhelming experience. I actually really like it. I really like it. So let's check out this view here actually real quick before we hit the charts, right? So we actually have, was that lightning just now? That was crazy. But anyways, let's open this balcony, see what we got going on. So we are on the cruise, MSC, and it's kind of, the ocean is very like rocky today. We are kind of feel the sways of going back and forth, almost busted my ass a couple times, but this is what we got right now. We're in the middle of the ocean. We have absolutely no land anywhere. Let's see this. No land anywhere in sight. And so, yeah. Let's talk about these options though. All right, and we're here. So I had to apologies in advance for the audio being a little bit messed up because I had to switch my different headphones here because I forgot my other headphones. But we still gotta try to get this content out. So we're here with this beautiful background view. But anyways, let's go into explaining where we are or how we got here. So essentially, we were running the options wheel strategy on Coles, right? So the first thing we did was we sold a Coles $21 put, and we did this in January 9th, the expiration date 2 weeks out. So just to follow me along here. So at the time when we made that trade, it was like January 9th, which was somewhere right here, literally this day here. So we were like up here in this area. And like I literally seen that the market can come back down into this box here. This is huge gap from the earnings. And that's exactly what we did. So the timing on our trade was kind of completely off on the first trade that we did. But it's okay because this is the beauty of selling options. Whether you win or lose, whether you're right or wrong, you're still okay. So what happened was we sold that contract, collected 285, and then actually got assigned to me because by the time that Coles expired, that the contract expired on the 23rd, it was below our strike price. It was below $21, right? So we ended up, by the time the date came, Friday, 23rd, we got assigned those shares, and we got assigned at the cost basis of $20.05 because we sold $21 put, but as you can see here, 3 contracts are sold at 95 cents. So if you take the strike price and subtract the premium that you got, that will give you your cost basis for the shares that you got assigned. And I actually I put it on the chart here. So $20.05 is my cost basis for the 300 shares that we currently had. So as we got assigned, now the next step in the wheel strategy is just writing calls on it, right? So basically that is what we did, but I'm going to show up some screenshots here and explain why I ended up I ended up going for the contract with a little bit more premium, or sorry, with a little bit less upfront premium, but I'm actually going to be getting paid a little bit more. So what we did was we sold 3 contracts at 69 cents for a $20 and 50 cent strike price, and we did this 2 weeks out because we executed this on the 13th. Now let's see. I'm just going to cut to the screenshots, and then I'm just going to explain what we were looking at on the options chain. All right, so here is the screenshot of the options chain of right when I did it. So this was the strike price, or this is the contract that we were looking for. We did a $20.05 strike, 20.5 strike, and we were going to get paid originally 72 cents for it. And now here's where like you can see how the price of these contracts change pretty fast. So it's like you're not always going to have the perfect timing on things, but you want to see, you want to obviously get the best deal that you can. So this screenshot was taken at 12:33 p.m. on I think that was Thursday, 12:33 p.m. So again, this is the contract that I wanted, 72 cents. Um, we could have sold the $20 strike, but we would have got a little bit more premium, but you actually end up making more on this on the lower premium one, and I'll explain why in 1 second. I just want to show how quick, like, just look at how the price of these options changed just 2 hours later. So just about 2 hours later, you can see the same strike, same contract. This is going for 66 cents instead of our 72 here. So, you know, I think at the time the price of coals was going down. So that's why the price of the options is going down. So as you can see, the price change, like originally this $20 strike 2 weeks out would have given us 92 cents. And then, 2 hours later, the price of the contract is going down. So this is why I wanted to write this contract before, like just in case Coles crashed over the weekends or something. And like we're gonna talk briefly about that too. There's a lot of developing news over the weekend about the jobs report being revised down and how that's going to impact the market. But before we get there, let me explain why you'd be making more money on the $20.05 versus the $20. So these we're gonna go with these more accurate prices because I think this is the actual contract that I sold. So, but I did a limit price for instead of 66, we sold it at 69 cents, just so we get a little bit a couple more dollars. But let me tell you why you'd be making more money if this expired on you versus if this expired on you. Now, bear with me here. Remember our cost basis, we have currently 300 shares of Colt. Our cost basis for that is $20.05. So if we sell, remember, anytime you write a covered call, it's basically like saying you're okay with selling shares at that price. So if we're okay with selling our shares at $20, well, we'd be losing 5 cents on each of those shares. And then you can do the math on that. So 5 cents times 300, that's how much money we'd actually end up losing based off of our assignment in the puts, right? So if we sold this contract, we would have got a little bit more premium, yes. And then this is basically how you got to do the math. Since we're losing 5 cents, you basically subtract the 5 cents or you take 5 cents away from this premium here. Because you got always remember that you want to pay attention to your cost basis when you're running the wheel strategy here. So again, we got assigned that $20.05. If we sell it for less, if we sell our shares for less than $20.05, we're losing money on our shares. And our goal in any time we're investing is not to lose money, right? So how much money would we lose though? We would lose the, you know, your cost basis minus your strike price here. So that the difference there is 5 cents. $20.05 minus 20 is 5 cents, right? So we would lose 5 cents here, and then we would gain 87 cents here. So you put that two together, we actually total gain on this, if you were to write this contract, is actually only 82 cents. And then we have 300 shares, so 82 times 3, 82 cents. Well, the math technically goes 82 cents times 100 times 3. That gives us the premium that we collected. It was like $207. But, or which, well, no, we collected that premium because we sold this contract. So I know I might be all over the place right here, but bear with me. Now, again, we own our shares at $20.05. If we were to sell it at $20.50, well, that's a gain. We sold it at higher than what we paid for it, right? So how do you calculate that out? So you do $20.05 minus cost basis, which is 20. Sorry. You do $20.50 minus cost basis, which is $20.05. And that difference there is about 45 cents. So in the worst case scenario that the shares get called away from us, we would still make money. We still make money because we're selling it higher than our cost basis. So we make 45 cents by selling it at this strike price, but we also get paid a premium for it, right? So if we get assigned, or if the shares get called away from us, trying to use the proper verbiage here, we would sell it at a profit of 45 cents plus 66 cents. So you could put that two together. 45 cents plus 66 cents is over a dollar. I think it's like $1.11 or $1.12, whatever it is. But we would make $1.12 total by selling this contract versus selling this contract, because obviously we would get paid a little bit more premium if we sold a $20 strike, which is, like 20 cents more premium. But in the event that this contract expires in the money and our shares gets called away, well, then you kind of lost money here, but you made money on the premium. Was the premium really worth it at that point? You know, and it's like you don't even have to take that risk. You don't even have to take that risk. All you can do is, as long as you're writing a contract to sell your shares above your strike price or your cost basis, you'll be able to make money that way. So just once again, you sold this contract 45 cents plus 66 cents. That's the total amount that we would get. Now, in the most ideal scenario, you know, in the most ideal scenario, if by the time by the time the contract expires, February 27th, um, Coles should be underneath this amount. So ideally, if the contract expires worthless, you know, that's the only scenario where selling this contract would um, make us more money. But we have no guarantees of what Coles will do, right? And another reason why I picked this strike expiration date versus March 6th is because Coles has earnings on March the 3rd, I think. So we can actually go ahead and look at it here. I'm kind of done with this screenshot, but Coles has earnings, as you can see, on March 6th, or sorry, March 3rd. And you know what? I have no idea what Coles is going to do on its earnings. It could probably go short squeeze again and go all the way up, or it can tank because people don't like the earnings. I don't really know, and I don't really care. That's why I'm going to write my contract for expiring before earnings, you know, before earnings. So again, that's exactly why we did the contract that we did. So really what we did was like we make 45 cents on the strike plus the 69 cents because we sold it as a limit, and then we got paid our $207 in premium. So ideally, I really don't want to hold on to coal shares. I found another ticker symbol that we can get a lot more premium and kind of grow this account a lot more faster. So I kind of do want this. I do kind of want this to expire in the money so that we get our money back. Like we sell our shares and we get our money back, but we still make some money. And then we go on and run the wheel on a different ticker symbol. That's kind of what the goal is here. So we'll see exactly what happens on the 27th. Hopefully, just based off the, what we price action we're seeing here, like I had a feeling that we can come down into this zone, but now it looks like we kind of broke out of that and we can continue going higher. The market's respecting this trend line. Coles might go higher, which is a good scenario because I don't want these shares. I don't want to hold these shares anymore. Um, I'm good with them. On this account, you could run the wheel on another higher paying premium ticker symbol. So that's pretty much the update with the options account. And then just briefly, let's just discuss like what's going on with the jobs numbers. So I think we had, let's see, I think we had the jobs numbers recently. What's today? Yeah, we had the job numbers. Was it on Friday? When did we get our jobs numbers? Oh, Thursday. Yeah, Thursday. Wednesday and Thursday. We got the unemployment rate, and then we got unemployment claims. I think this is what was going to be revised. I think the unemployment claims, it's like they have it as like 220, whatever the number is, 227K. But I think the number, the headline came out to be like 1 million job reports. I'll try to find a screenshot and throw it in here. But it was like 1 million report people claimed unemployment. And that was like, totally unexpected. So as we already know, just to briefly talk about like the domino effect there, it's like the Federal Reserve has a dual mandate. Their dual mandate is maximum employment and price stability. So if they're messing up on the maximum employment side, that's going to more or less influence interest rates. And basically, right now, the way the economy is going, they think that, or they want to, the Fed, it's like the Fed thinks we're good at holding, keeping rates higher, but Trump and his team wants rates to come lower. And I think at the very last Fed watch, they kept rates the same. But with this new revision in the jobs numbers, people are already saying, and it's always funny how these things happen over the weekend. So you can't like react to it at all. You have to wait until the market opens and then see how that turns out. But it's going to definitely have huge implications on what people think the interest rates will be. So as of right now, they're looking at the next meeting, which is in March. Their market is pricing in a 7% chance that we are going to get interest rates, or sorry, 7% chance that we're going to cut interest rates. So we have to see kind of how this number changes this week. We have to see how this number changes this week. If this is going to become a higher probability of rates coming down, let's see. That could be, I wonder, that might be bullish for the stock market. That might be bullish for the stock market. But it's kind of hard to say because there's a lot of different moving parts, and the market doesn't like surprises. The the job numbers, the new jobs numbers, is kind of like a surprise to the market because now it kind of shocks things. It's like, are we going to cut rates now? Well, maybe that might have a negative effect. I don't know. It's kind of hard to say. But generally speaking, when rates come down, you know, the market prices go up because companies can refinance their debt at lower rates, save money, all that good jazz. But that's pretty much the update video I had. Kind of wanted to talk about the market for a little bit, like the macro look of the market right now. Like we're going to see how this week is going to be a very interesting week in the market. Um, if you are looking to pick up some positions, might not be a bad time to add to some positions that are down. I know crypto's been down for a while now, and I think it's going to go down a little bit more. We had a small bounce, but it's like look at Bitcoin rather. It's like this could be a bottom. This could be a bottom, but I don't know. I feel like this isn't violent enough. Like if this is going to be the bottom 60K before we go back up to 200K, I don't know. It doesn't to me. It just doesn't look like it could be a bottom yet. We have to see more panic, more selling, more aggressive volume spikes. But that's all I have for you guys. Look out to see what happens this week, and yeah, happy trading. Good luck in the markets, and peace out.